It's funny because you hear all these things, right? No taxes on tips, no tax on Social Security, huge SALT tax increase. And you would think that the bill itself is the problem. And for me, it's not the bill itself. It's the messaging around it. That's the problem, right? That's the thing. It's like, no, that's not true. Run your home and your dough like a biblical boss.
Well, Jed, welcome back to the Abraham's Well podcast. You have become a frequent guest and our resident tax expert as the owner of what I would assume is the first accounting firm that I would find if I opened a phone book and looked for a CPA, because
Yeah,
that's what your
that's why.
business is called.
That's why we put that name. I just want to be at the top of the list, really. So thanks for having me again.
It's like the old AAA plumbing back in the days of phone book. Yeah. So, how did you name your firm, ACPA Inc.?
I am very bad at naming things. And honestly, I woke up one morning and that was the name I felt like the Lord gave me, so I went with it. That's literally what it is.
And so, if somebody's like, "Do you know a CPA?" and you
Yeah,
can say that, yes.
exactly. Now
Well,
my website is acpainc.com, and so it says acpain.com, and so I didn't think about that piece when doing it, but what are you gonna do?
that's funny. Well, you've sort of become our go-to guy when there's major changes in the tax codes or things that people are looking for. And actually, over on which is our community for supporters of this podcast, where a bunch of dudes and a few ladies get together and encourage each other and ask questions and have debates. We had a big debate recently about the benefits and reasonable expectations for what a grown man should be able to deadlift. So we have all sorts of arguments over there. But one thing that I thought was pretty cool is somebody requested that Jed come on the podcast and straighten us out on this new big wonderful tax bill that has just passed that has quite a few changes. So, uh, praise the Lord. I sent you a message and you were available, and just a few days later, here we are recording a review of I'm not sure. This is my first question of the whole podcast, but what are we going to call this thing? How do you pronounce it?
I've heard a lot of different ways. I've heard the OBBBA, right?
That's how it's
I've
always
also
written.
That's not actually how it's all in our tax software or in our tax research. It's actually just two B's, which I don't understand. OBBA. You know what I'm saying? I don't. There's an extra
One
B in there. I don't know if
big
they got. Yeah, I don't know if they get rid of big or beautiful or bill. I'm not sure what they got rid of when they were doing the OBBA. But O triple BA. I always get. I forget how many B's I've said right when I do that. So I have typically been just going with one big beautiful bill and saying it exactly like that, as smoothie silky as I can.
uh,
But
I like Obaba.
yeah, that's right. Obaba, right? Or Oba, right? It's almost
Yeah.
like you're saying Opa or something like that, right?
All right. Well,
Oba.
in your best Trump voice, why don't you you don't
Yeah,
really
that's
have
not
to
gonna
do a
happen.
Trump
Yeah, that's not
impersonation.
gonna happen.
But we're here to talk about the One Big Beautiful Bill Act, which made some really big changes to the tax code. And like you said, every time you've been on this podcast, the only thing we know for sure is that a lot of these things will change again soon. So you're going to have a job for a while, is my guess. And should we just jump in with my questions? My goal today is to just kind of hit you with, we're here to serve the people, Jed. We're not here to nerd out on the intricacies of the tax code. So I'm going to
Agreed.
do my very best Stephen Manuel impersonation and cut you off if you start getting into the details, which personally I would pay you separately from this podcast to teach me about all the really the minutia of this bill. But for most of our listeners, they're just wondering, does this change things for me? What should I care about? And so I've tried to kind of highlight some areas that I think are going to be most impactful to our listeners.
Yeah, absolutely. I think let's stay high level. Um, let's not get caught up in the weeds. To your point, I absolutely can. And I would just say that anything that we say today, it could change. And what I mean by that is that I just got off of a continuing education through my professional, AICPA professional board or whatever, and they are saying like, "Hey, as this gets interpreted, they are very much into helping the IRS interpret this that is in ways that are going to help us." And so there's a lot of interpretation to be done. So I say that to say there's a lot of questions that may not be able to be answered, even if you did decide to get in the weeds. And it's just going to take time for that all to shake out.
Awesome. Well, before I ask you my first question, why don't you give us 30 seconds on who you are? Just because if somebody has been hiding under a rock, they might not know who Jed is. And I'm interested, you're not just an accountant, you're also a father. So give us the quick rundown on what you're all about, Jed.
Absolutely. My name is Jed Kinderknecht. I am the owner of ACPA Inc. My background is actually in secondary education mathematics, so I was going to be a high school math teacher for a bit of time. I am married to a lovely woman named Monica, and I have two children, one that is 18, about to be in college this next year, and one that is 16. He's going to be a junior. We are very active at our church and in sports and just in our community. And so, yeah, so that's just a little
Y-
bit about me, anyways.
And I'm Mark Parrott. I am one of the regular co hosts of the Abraham's Lot podcast. My usual compatriot, Stephen Manuel, is in the south of France right now,
Oh, nice.
celebrating a major birthday for his wife. And so they are doing a kind of a dream vacation at the moment, which means, Jed, it's just you and I today. And just to jump into this bill, I think, one of the this one, I don't want to be too pessimistic or skeptical of the motives, but there's a lot of clickbait, I would call it, in this bill, and the one that I've seen the most headlines about say tips are no longer taxed. So tell us about tax on tips, and can I now say that all financial planning is free, but there's a multi-thousand-dollar a year tip included? How does that work?
Right. Well, you're right that it's very much of a leading thing where it says, "Hey, no taxes on tips," because it is coming in the way of a deduction on your tax return. So, everything's still going to get reported a specific way when it comes to tips and that kind of stuff. But it is a deduction on your personal return, $25,000 per year per taxpayer is kind of the dollar amount. Um, it is in addition to the standard deduction, which is great, so it doesn't change that, right? The standard deduction is still there. This is, on top of that. It's still subject to Social Security and Medicare, so FICA, and probably state and local, and this is where we need the states to say whether they're gonna conform or not, right? So when there's no tax on tips, it's not technically true because you've got Social Security, Medicare tax, you may have state tax, you may have local tax, right? We're just talking about federal income tax that it's being, excluded from.
And it's only people who work in traditionally tipped roles, right?
Correct, yeah, so the tips have to be reported, on IRS approved forms. So there is no like, "Oh, I get to decide, it's whatever." This is gonna be they're trying to regulate this to put it on the onus of these reporting agencies, whether it's W-2s, 1099-Ks, and that sort of thing, which, it just to say whether it's tips or not, so the IRS can track this. And so where the gray area happens is what you said, which is these industries that are it is traditionally tipped. Well, there are some places that can be debatable. Unfortunately for you and I, not so much. It's not really something for us. Um, but again, it's the salon industry and restaurant industry. Those are obviously going to be the two very big ones. Delivery industry as well, right? So if you're doing DoorDash or that sort of thing.
Yeah, it'll be really interesting to see if people retaliate here and stop tipping. I had somebody, they always say it, Jed. They always say, it's just going to ask you a couple questions, and they hand you the iPad, and it's
Yeah, no
never a
big deal.
couple questions. It's
It's not.
always just one question. Um, And I had one put in my face the other day, and the lowest suggested tip was 30% of
I
my
can't
bill.
stand that. Yeah,
And
I'm not okay with that.
so it'll be interesting to see. Unfortunately, if you do decide to tip your financial planner or your accountant, we are not going to be able to deduct those tips. But that doesn't mean we won't still be happy to receive them. So
Agreed.
that's still an option, but no changes in this bill. Okay, so tax on tips might be helpful if you're a waiter and you were reporting your tips to begin with. If you weren't reporting your tips, that's not going to help you. The one that might be maybe more commonly applicable across our audience is last time you were on, we talked about the SALT cap, which is state and local tax. So if you're living in a state like Texas, for example, where all of their revenue, there's no income tax in Texas, all their revenue comes from real estate tax. A lot of people pay a whole lot of money on property tax, for example, and up until recently, the cap was $10,000, meaning if you had more than $10,000 in state and local taxes, you could only deduct 10. I know you've talked about some workarounds to that, but let's just roll with it for simplicity. That's changed, right? And so, how does this work out, and who's it going to help?
Yeah, so it's that cap is moving from 10,000 to 40,000. So that's a large increase, right? That's $30,000 increase. There is a limit on it, right? You have to make underneath $500,000, and then it starts getting phased out above that. So just recognize that, who it's going to help out again, to your point, is all these people, whether, whatever state you're in that has high real estate taxes, maybe state and local taxes. So, if you're paying more than that $10,000 and you're already itemizing, you know, if your total amount is $30,000, that's an extra $20,000 deduction that's just going to hit the bottom line for you, right? So that's a decent change there, right? And so, and then if you don't take the itemized deductions, if you take the standard deduction, this could actually push you over to taking itemized deductions. So that's really where you're gonna see that. So if you own a home, if you're making decent money, and especially here in Ohio, we have state and local taxes, right? So our state taxes aren't too bad, but then when you take into consideration local taxes, that kind of starts adding up, right? And so all of those things go underneath that. Um, just to make you aware, that limit of $10,000 returns in 2030. So again, this is one of those things that is not permanent. All right. So it's eventually at some point in time, this can potentially sunset, which is just something to recognize.
Yeah. And I don't know what your experience is. Mine is that the people who pay the most state and local taxes, maybe they own multiple properties, they have a vacation home, maybe they, just are high income, but a lot of them are over that phase out limit. So I don't know. I'm curious if this really ends up benefiting a ton of people, or is there
I
a
think you
fat?
would be surprised. I think you'd be
Okay.
surprised at the amount of people. I would say that the sweet spot for this is going to be the people that are making between 250 and 500, because I would
Okay.
think that if you're bringing in 250 to 500, your home is probably big enough where your real estate taxes are large. You're going to be paying some state and local taxes, and it's probably going to be more than 10K. Is it going to be 40K? No, it's not going to be 40K, right? It could be 25K. But again, it's not like you're spending any more money. This is money you're already spending. So even if it's an extra $1,000 that drops to the bottom line, that's a benefit, right? And
Yeah.
so so I would say the sweet spot for this is going to be that 250 to $500,000 of adjusted gross income. You're going to be in that 24% tax bracket ish, and you're going to be able to take an extra 20 grand off the bottom line. This is a good thing.
Yep. And just to be clear, that means I'm not going to pay tax on an extra 20 grand. Not I get 20 grand less in taxes. I'm just going to not pay income tax federally on that extra
Correct.
20 grand.
That's
So,
correct. Yes, it's a deduction.
yep. Okay. One of the specific questions that one of our listeners asked you to opine on was these Trump accounts, which maybe another clickbait item in this bill, but they've created these new accounts that are ostensibly designed for us to save for our kids. I mean, that sounds right down the middle for Abraham's wallet. The government is going to put some money in them when your kid is born, right? And so I've got all kinds of questions here, but can you give us a quick summary of what they are? and just tell us now, how does that change maybe if we were saving into a 529 account or thinking about saving for a home down payment for our kids? Is it all Trump accounts now, or are we still using these other things?
Yeah, great question. So high level, it's a new tax deferred account for children. $5,000 contribution limit. Can't put any money in after they're 18. Restrictions on what it can be invested in. Okay, so there's a really specific sort of things that it has to be invested in, and what I mean by that is like low cost ETFs and that kind of thing, right? So indexed things you can't. I don't think you can like you can't do real estate or gold or that kind of stuff, right? It has to be very specific things. No distributions until you're 18. There are very few exceptions, but for the most part, can't do that. Specifically about putting money in from the government, it's a pilot program that $1,000 for newborn accounts, right? So newborn children that get these accounts from 2025 to 2028, unless the parents opt out. So it's automatically going to happen if they qualify. It's just going to happen. So it's almost like those unclaimed funds, right? If you don't think about it, you don't say no, they're going to do it. Um, so that's kind of the high level when it comes to it. Is not a deduction. It's not like you get to put $5,000 into the account and then it's going to reduce your tax liability. This is not that, right? It is a little bit more like that 529, which I'm going to put the money in. I'm not going to take a tax benefit, and then it's going to grow. It's going to grow tax free until what time I start taking money out.
And when you do take money out, my understanding is that there's some limits on what that money can be used for, correct?
Without any kind of penalty. And this is where we start to get into that area where they have not fully defined that yet. So what that looks like, what the taxability is. I had a question is, if I put this money in, can I just convert it to a Roth? And all my software says, we don't know yet. So these Trump accounts are new and nobody has flushed out the details yet. Now, I will say this, you cannot start putting money in these things until 2026. So
Okay.
Trump accounts are not, you can't even open them. So it is giving them time between now and the end of the year to create the mechanism to be able to do these things and be able to start having these actually function.
So for now, it'll be 3 years, and the people who really hit the jackpot are the babies that get born in this first 3 years, assuming it sticks around. They're going to get $1,000 unless they specifically call the government and say, please don't give me money. They're going to get $1,000 in one of these accounts, and it's a little TBD what that can be used for, but the things we know are you can put 5 grand a year into an account for your kid, and they won't be able to get it out till they're 18, and at that point for specific approved purposes.
Correct. And the positive is that you don't have to have earned income. So right now, if a kid wanted to put money in a Roth IRA, they have to have earned income. So either they got to be working a job, be employed by your business or something like that. There's no requirement here. So that's kind of the nice part is like they don't have to do anything to be able to do this. And the other thing is I want to make sure that it's the pilot program that's from 2025 to 2028 for the $1,000. These Trump accounts are currently even beyond that, right? So you'll be able to use these Trump accounts going forward as long as they don't change any of the rules. The $1,000 is the only piece that is only for those brief years.
Yeah. I mean, from a financial advisor's standpoint, it's an interesting thing to think about because for the first time, we've had Social Security and we've had government programs where the government's kind of putting aside some money for you. This is the first time that the government has said we're explicitly going to have every American participate in the stock market. And so, how that could affect the broader market? Could that create lift in stock prices? Could that be a tool that the government uses when the market's not doing so great and whoever's in political power needs to boost it a bit? Hey, guess what? We're going to add some money to everybody's Trump account. We shall see. I think that unfortunately for the listener who asked this question, there's a lot we don't know yet. Um, and it does not sound to me like these accounts, based on what we do know, are necessarily going to be quite as multi-generational in nature as a 529, for example, because they will turn into an IRA under the current rules once a child hits 18, and we know that IRAs cannot persist past the life of the initial account holder, whereas 529s, there's some tricks we can use to kind of make them at least be usable for multiple generations.
Yeah, it's an interesting tool to have in the toolbox, but there are definitely other ones that I would want to utilize first. I'm not saying this is last, but
Okay,
it's not like everybody should go out and do this. It's a no-brainer. This should be the first $5,000 you're gonna put away before anything else.
cool. My next question, this is another big headline, and maybe our listeners who trend towards the not yet receiving Social Security end of the age spectrum, maybe they're not too tuned in on this, but maybe you have parents who are taking Social Security, or maybe you even done some financial planning and said, I don't think Social Security is even going to exist by the time I'm 71 or whatever the age is by then. But the headline is Social Security is no longer taxable. And I kind of started digging into the bill and I thought, I don't think that's true. But Jed, tell us, what's the new situation when it comes to Social Security and taxes based on this bill?
Yeah, it's certainly not the no tax on Social Security that I was hoping for. Absolutely not. And it is it going to help? Sure, it will. So it's the basics are it's a $6,000 deduction per person if you're over a certain age, and so $6,000 at a 22% tax break is a little over $1,300. That's something, right? I mean, that's absolutely something. But it's certainly not no tax on Social Security, right? So Social Security is still going to be taxed. The big question that I have, and again, this is one of those things that's not been defined yet, is this deduction taken before Social Security is figured, the taxability of the Social Security is figured, or after? Because when I was doing this for some people that I have that are in retirement, that's a big change. Because if I take it before the taxability of Social Security is determined, that drops my AGI, which means less of my Social Security is actually taxed. And it's way more powerful as opposed to if it's after. So that's one where I'm not sure where it's going to happen, where that math happens. If it's before and it affects the amount of Social Security that is paid, or excuse me, that is taxed, that's going to be an even bigger win.
Got it. Same question, same kind of is this real? But another headline I saw is now you don't have to pay taxes on overtime pay. I know there's a rule about overtime pay, but what is it?
Well, I told my people I'm going to pay them all overtime now. That's what's going to happen here for the next few months. No, so it's very similar to the tips, right? The deduction of overtime pay it's not there's no tax. It's still subject to Social Security and Medicare and state and local, right? So it's again we're just talking about federal income tax. It has its own phase outs as well. Um, and as far as what qualifies as overtime compensation, they've specifically said that this is regulated under the Fair Labor Standards Act. So we just can't make things up and call things overtime. It has to be required to be paid based on the Fair Labor Standards Act. So again, most of the people that work for me are all professionals. They are exempt from overtime. Therefore, it's not going to affect them, right? And so highly compensated employees and that kind of stuff, again, not going to affect them. What we're talking about is typically the worker is getting paid per hour. You know what I'm saying? You work over 40 hours a week and you get paid time and a half. That's really what we're talking about. It's all going to get reported on IRS forms. So it's one of those things where you're either in it or you're not.
Yeah, that makes sense. I think that there's kind of a grab bag of stuff that I wanted to hit before we keep digging into this. Before I get there, I was told that this bill in total really does look like for most people who are on the top 10% of the earning spectrum, like it's going to be a good thing for them. And those in the bottom half might actually pay a little more tax. But everything you've talked about sounds like it's like, well, this gets phased out for high income, this gets phased out for high income. Is that just because the phase outs are really high and so maybe the top 1% doesn't experience those? Like, how does this work? Is it good for high earners? Is it good for kind of people who are just starting out, maybe have a lower end adjusted gross income? Who's this really gonna help the most?
I think there is really no who is it going to help the most because I think that there are definitely winners and losers in all of this, right? I think that what it's going to help people with in the lower income tax brackets, it's going to allow them to reduce their income by things that they're already doing, right? And in other words, they don't have to do anything. right? I work in a tipped industry. I don't have to do anything, and all of a sudden, it's a benefit to the bottom line. I work in an industry where there's overtime. I'm just walking into it, right? I'm on Social Security, right, and have retirement income. I'm just walking into these things, right? So there's no active thing. It's not doesn't cost them any money to do that, and I think that those are things that are benefits, right? Then you've got some of the other things like the Trump accounts and some other places when people have just extra money to put away. It's kind of that higher tax bracket. It's like, okay, if you have extra money, here's some places that you can continue to stash it. So I really think that it has something for everyone. But obviously, when you have people that are in the higher tax bracket and they do something, it's going to have a greater impact because 37% of something is higher than 12% of something, right? Um, that's what I think you have to recognize of whether you're looking at it from a dollar for dollar standpoint, or a percentage standpoint. And I think ultimately, like I said, I think there really is something for almost everybody in here, but I think that it's there's no necessarily like major winner.
Yeah. I think we could say that perhaps what is it, $3.7 trillion this is adding to the deficit could suggest that we all might be major losers as a result of this
That
spending amount.
that is 100% a fair statement. Yeah, I don't know if the cost is worth the benefit all the way around. But again, this is where the tax provision, they make the rules, and so we just play by them.
Okay, I'm gonna kind of take a mid-podcast pause here, and we're gonna just hit a few like little bullet points that I don't think are gonna apply to everyone, but if they apply to you, they might be really important. So let me run down a couple of those. There's a new adoption credit or an enhanced adoption credit. What's that about?
Previously, adoption credit was not refundable. One of the biggest things that changed is now a portion of it can be refunded to you if you don't have any kind of income tax.
Okay, so somebody who maybe is lower income and adopts a child could get a tax refund of that credit, whereas before it could only take them to zero.
Correct.
Okay. Um, okay, I'm very interested in this one. Additional expenses are now allowed to come out of the 529s. Previously, it was qualified higher education expenses, and then some states allowed K through 12 for $10,000 a year. But what's new? What additional expenses now?
Well, they upped the $10,000 amount. I believe it's $20,000. Don't quote me on that, but they definitely enhanced that, raised that dollar amount for high school. But it also can be homeschool, some homeschool things, private schools, those sort of things. Is kind of how they expanded that, as well as if you're graduating and let's say you wanted to take the CPA exam, you could use those 529 funds to pay for licensure, certifications, that sort of thing. So again, that's very new when it comes to the 529 accounts.
Okay, and is the K through 12 or high school or whatever it is that federal now so that
It
states
is.
can't? Because previously some states said you can't do it. So now all states you can use your 529 for private school.
Well, I wouldn't say that. I would say that the federal government is not going to tax you on taking it out to pay for those. However, if a state really wants to say no, they could actually have it be an add back. So this is where state and
For state
federal don't
income.
necessarily conform if they don't want to. So you got to check your state on that.
Got it. Um, okay. How about this one? Holy smokes, Jed. I don't know if you and I have ever talked about this, but paid for a lot of my wife's medical education sitting at poker tables in Las Vegas
Oh,
sometimes.
yes.
And
Okay.
I still have friends who this is a significant part of their income. And I looked at somebody's books the other day. They said, check out my last year of winnings and losings. And they had wagered something, they had lost something like $800,000 over the course of the year, and they had won about 1 million. Um, so previously, what this means is good job. You made $200,000 gambling this year. You're going to pay income tax on $200,000. That's not the case anymore. So what's up with the new wagering rules?
I will say I had no idea this was even being talked about until I randomly read it and I went, "What?" So, to your point, usually you could write off all of your losses against your income up to your income, but now they are limiting it to 90%. So, right there, even if you have losses that are over your winnings, you are going to pay taxes on those gambling on gambling income. It's
It's
just it's wild. I don't even understand how it happened.
Yeah, and so for these high volume players, they could actually win a substantial, like, healthy amount and be negative after tax because they're going to pay tax on 10% of their losses. And if those numbers are big enough, you would lose money no matter how much you made.
That's
And
correct.
I have mixed feelings on this because, on the one hand, I don't think gambling, even though I really enjoyed it and used it to fund some family goals of ours, I don't think it's a net positive for society. But it also feels a little bit weird. Is this just the attempt of the government to shut down gambling or what? I can't tell.
I can't tell either because it really did come out of nowhere. Nowhere did I hear anybody talking about this in any of the reading that I did when it passed the House the first time and then the Senate and the reconciliation. Nobody said boo about this. And then all of a sudden, I was reading the summary and I was like, "I'm sorry, what? Like how did this happen and who who was okay with this?" It just seems it just seems random. Like there's all these things and oh by the way, we're going to limit wager losses. Like I don't that seems just out of nowhere. So somebody had a pet peeve somewhere and slipped that sucker in.
Is there any risk that this type of logic expands and, like, my business expenses, I can only deduct 10,
Listen, bite your tongue. Don't
90% of
even
them?
say it out there, man. Don't.
Because it could be the end of all business in the world if we did that. Um, in any
Let's
case,
see what happens. Well, let's
uh,
let's
there
hope not.
the last thing on my kind of not applying to everyone, but important if it does apply to you, is there's a change in 1099 income reporting.
Oh, let's go.
So
I'm so
what?
excited for this.
Tell us about this.
Well, I don't have the specifics in front of me, but let's just say that I think it starts in 2027. So this is something that's going to be a little bit further away. And so right now you have to, if you pay somebody as a business owner, you have to pay somebody and you do a $600, pay them over $600, you have to issue them a 1099. That threshold is going up to, I think, like $1,700 or something like that. It's like a couple $1,000s now. And so like the amount of reporting that's gonna have to get done is so much less. And so that's nice when you are the reporter. But know that that's not happening here for a few years. But it will be nice when it comes to not having to track down people for 1099s, especially honestly for us. Like that just takes forever to do and it's just a pain. Now, I will say this doesn't mean you don't have to claim the income and that kind of stuff. There's nothing to do with that. It's everything to do with just reporting it to the IRS.
So under the current $600 rule, theoretically, tell me if I'm wrong, this means that if I hire a babysitter for $100 and I hire a night and I hire for 7 nights, I have to fill out a 1099 and report that income, right?
No, actually, this 1099s are only for business expenses. So that's when you're hiring a babysitter, that's typically a personal expense. And so no, you would not have to do that. You've never had to do that when it comes to that. So this does not help the individual any, or a non-business owner really, in my opinion, except for maybe you just receive less 1099s. This is more of a reducing the requirement for a business to issue those.
Got it. So when my cleaning crew said we no longer take Venmo as soon as the rules changed to $600, is that gonna be impacted by this at all or no?
I mean, it could. People could be more apt to be okay with it. Yeah, again, for me, it just more removes the requirement from the business owner, right?
Got it.
And I did just look up real quick. It's $2,000. So I mean, that's a good increase there that you don't have to be waiting around. Oh, I made $700 from this person ish. Do I need to wait for them to send the 1099 or anything like that? So I consider this just a win for business owners to not have to worry about reporting as much.
Got it. Um, okay. Um, and business owners in general got some pretty big, supposedly permanent changes in this bill as well. So there's this small business 20% deduction, and that got expanded or made permanent. What happened there? How does this help business owners?
Yeah, so a lot of things that were done underneath the TCJA. So that was the first bill when President Trump was in office and came through. Got this thing called QBID, Qualified Business Income Deduction, was the 20%, but it was supposed to be done at the end of 2025. So now it has been made permanent, which is great. There were some limitations around it depending on your industry. They've expanded those, which is great. The other thing that they have done is they have brought back 100% bonus depreciation for those of you that buy big pieces of equipment and that sort of thing. They brought back 100%. It was slowly getting phased down, so it's nice that that is back. And so those are probably those are the big things. So really for business owners, it's not necessarily a change that happened for them. It was more of a extension of what was already happening and making permanent a good bit of it. So it creates a level of certainty that you can make decisions on.
And that bonus depreciation thing, that's kind of the trick as a financial planner that we've used if somebody is really dead set on I need tax deductions. Now, they could go out and buy a short-term rental and depreciate not the whole price they paid because there's land and things like that you can't depreciate, but they could take a humongo deduction for basically depreciating the entire structure. I'm simplifying, but a large chunk of that structure all in the first year of ownership. That's coming back now. Do you think that those things for the everyman, meaning I'm not talking about the guy who's buying heavy machinery for his manufacturing business, I think it's a net positive for him. But for people who are kind of trying to use the tax code to just save on taxes now, is this a good thing? Is it open the door to make mistakes and let the tax tail make decisions
I
for the
think it
dog?
opens the yeah, I think it actually opens it for the majority of people, right? Unless you are in the industry of buying big pieces of equipment and that kind of stuff, or again, unless you have money that you can just throw around and do the thing you were talking about, which is called cost segregation and that kind of stuff, because there's expenses associated with that. Not everybody can just go buy a short-term rental, right? And so for the everyman, I think that it actually opens you up to have a feeling that I should spend money for a tax deduction. And that is not why you should spend money is for a tax deduction. It's good to get a tax deduction, but again, I'm not going to go out and buy a whole bunch of new computer equipment and just have it sit in the corner. I'm not going to go buy custom furniture for my office that nobody ever comes into except for me, right? I'm just not going to do those things and because I'm spending more money than I am getting getting a tax benefit, right? Because it's not a
Yeah,
credit. We're not talking a dollar for dollar benefit here. It's a percentage. And so for the majority of the people, especially when I start talking to people around vehicles and hey, I'm just going to buy a big truck and I'm going to write it all off in 1 year, but then they end up selling it and you have this thing called depreciation add back and it's just moving money around. And so I think you
man.
just have to be a little bit more strategic and think a little bit more long term. But at the same time, if you were planning on buying something in January or February or March and you can buy it in November or December, do it because then you get to write it off for this year. Or if you just know you're going to have an exceptionally large year, you can kind of manipulate things that way.
Right. Yeah, it's been kind of an interesting year in watching people make decisions to save money on taxes and not if you want to have a bad day, join me in a meeting with somebody who did 100% bonus depreciation on a house and then for whatever reason has to sell that house and can't exchange it into another property and they go, "Wait a second. Why are the capital gains so high?" Well, it's because you're now paying tax on 100% instead of just what went up. So, yeah, what goes up must come down. This rule applies to taxes. And like you said, I think this can be useful for smoothing things out in certain circumstances. But you do get in trouble when you make decisions purely based on the immediate tax consequences of those decisions. So,
Yeah, agreed.
um, Interesting to see how that plays out. I think maybe the one that I most took a big deep sigh and my heart sank when I read it was that they're changing some charitable contribution rules. Um, I've always sort of wondered when the US government would stop uh, benefiting charitable giving because it just doesn't seem like that's really their business, but they have, and as long as they have, I've said, hallelujah, let's take advantage of that tax break for giving. But can you just talk us through what changed and what, if anything, what are we supposed to do differently now?
Yeah, I hear you. When I saw that, I was like, "Oh, that stinks," because it's like, you want people to be charitable, and all of a sudden, it's like it doesn't give you as much tax benefit, somewhat. But ultimately, I think there are some positives to be taken away from this as well. First things first, doesn't go into effect until 2026. So 2025, you're golden. Still old rules. Okay. For 2026, what we're talking about as far as a negative is they're putting in what they call a floor, and so if you itemize, your charitable deductions are have to get over this floor, which is fairly small. It is 0.5%, so 0.005 of your adjusted gross income, right? So that first X is not, you cannot take everything above and beyond that would be go into the calculation of an itemized deduction. Okay, so that's the negative. A couple positives though. Any of the disallowed amounts are carried forward for 5 years. So anything that falls in, so if you have a really, really good year and your floor is higher, and then the next year you go back to a normal and your floor drops down, anything that you couldn't use rolls forward for 5 years. You take your current year contributions first, and then anything left over, if you still have more room to take there, you get to. So it doesn't just go away at that point. There is a little bit of a mechanism to be able to recapture some of that as you go. Okay. The other thing positive is they did make a permanent non-itemizer charitable deduction. $1,000 for an individual, $2,000 for a joint. The people this is going to help us, man. Oh, Abraham's Wallet. We're dealing with a good bit of people that are, I would say, probably younger that are early, in family and that kind of stuff, and they may not be itemizing, but they're still doing the things that we all talk about, which is giving, and they've had no tax benefit for those givings, and now you get some. For me, I'm like, if it spurs more people to give, I'm willing to give up my 0.5% floor
Yeah.
personally. If it spurs more people to give, and I think more people will, because even if you aren't itemizing, I don't have state and local taxes, or I don't have a mortgage interest in this kind of stuff, you're still going to be able to get a benefit. Or I love the college students that are just coming out and they're giving to their church, two, three, $4,000 a year, but they don't own a home, they don't have kids. You know what I'm saying? And so they don't really get a tax benefit, but they're still doing it. And so for me, it's like, no, I think this is actually going to spur some. So while there is a little bit of a negative, for me, I think that there's enough positive that it outweighs it.
Yeah. Well, I hadn't thought of it from that angle. If we can kind of build the giving muscle in the younger folks early
Yes.
on,
Yes.
and that leads to long-term giving, completely aside from the tax consequences, just the joy and benefits of giving, even to the giver, then I guess you might have convinced me that this is a net positive. Um, okay. Before we shut down, I do guys like you just love when things like this happen and everything changes because it guarantees like job security, or do you dread the panicked emails and last minute changes as much as we do over in the financial planning world?
It's for sure love hate, right? I love that I feel like I have more tools now, right? I feel like I'm going to be able to provide value to my clients, to my friends, to the community, to the people on Earth. You know what I'm saying? Like I have an ability to help at navigate these changes because the changes are going to happen no matter what. There is a hate piece, is because again, which is like I before it even passed, I had somebody email me and ask me what their new salt cap deduction was, and I'm like, "It's not we're not law yet, right?" And so there's definitely that, and there's a whole bunch of moving parts. I will say the benefit for this is that it is happening in July. If they would have waited to December, the closer we get to the end of the year, the worse that the hate piece happens, right? The more hate I have
Yeah.
for it because it gives us no time to do anything. And so that it's happening right now is decent. So again, it is a love-hate relationship with it, because we don't know for sure. How does this affect me? Well, like I said, my software hasn't even been able to update yet because they don't actually have regulations. It's law, but nobody's interpreted it yet. So we still have to wait for some time to get some guidance from the IRS, some regulation rules, and all that kind of stuff to be able to truly know how much we can utilize the tools they gave us. It's like getting a brand new tool and you're like, I've never seen this thing before. How exactly do you use it? Well, it just takes some time to figure out and you got to read the manual a little bit.
You're not allowed to just say, I read on the newspaper that tips and Social Security and overtime are all in tax, so I'm just not going to file a return this year because that was most of my income.
Exactly. Absolutely not. And that's the key, right? It's funny because you hear all these things, right? That you talk about no taxes on tips, no tax on Social Security, huge sole tax increase, right? Limit increase and all that kind of stuff. And you would think that the bill itself is the problem. And for me, it's not the bill itself. It's the messaging around it. That's the problem, right? That's the thing is that it's like, no, that's not true. And it's everybody, right? It's like, no, that's not true. No, that's not true. And that's why I've kind of tried to hold off from giving opinions or giving it advice around it because we didn't know what was going to happen, and it's not until here that this happened, and we still have to wait for some guidance to way we can truly know how these things kind of function with each other.
Yeah, that makes sense. Well, Jed, is there anything fun that's sneaking around and hiding in the corners of this bill that we forgot to talk about? Is there anything important that I missed before we send the people on their way?
I would say just maybe, I don't know if this is fun, but if you are looking at buying a new car interest loan, there
Oh,
is
yeah,
something to be
yeah. Tell
said
us
there,
about
right?
that one.
Yeah. So if you are looking for a new vehicle, it does have to be used, or excuse me, it does have to be new, not used. You can deduct up to $10,000 in car loan interest. There are some AGI limitations again, right? $100,000 for an individual, $200,000 for joint. It does, like I said, has to be a new vehicle, has to be purchased between 2025 and 2028. So again, it's a very limited time. And the final assembly has to be in the US. So again, if you find yourself looking for a new vehicle, I know we've talked to other people about buying cars and all that kind of stuff. You guys have given me some great advice and tips and tricks and that kind of stuff. And so just know that this can reduce as a deduction. Again, it's not a dollar for dollar tax credit. I would highly recommend if you can get one of those things where it's like, hey, 36 months or whatever it is for with no interest and that kind of stuff. That is way better than taking this. Okay. So I would rather you not pay the interest if possible. However, if you are going to pay car loan interest, this is just a little benefit that's in there.
Yeah, I'm curious what cars, obviously the American brands mostly assembled in the US. I was looking up like what counts as this bill that might be, um not your typical Ford, Chevy, GMC type brands, and the list is longer than you might think. So
100%. I mean,
Subaru
yeah.
has a few plants over in your neck of the woods in Indiana.
Honda. I was going to say
Acura's
Honda,
TLX is built in Marysville, Ohio.
Ohio, just down the street. That's really just down the street from us. That's what I was going to say. Yeah. We've got, there's a Honda Acura plant right out there that there are a number of cars that get final assembled directly here.
A ton of Toyotas. So if you want a Tundra, if you want to be like Mark Parrott from the Abraham's Lot podcast, you can get a Tundra that was built in Texas. So there are some cars in there that count. I think it's funny because we're saying this on a day that Ford just announced the recall of 850,000 vehicles, including basically every Bronco and Expedition that was built in the last 4 years. So my wife keeps saying, "I want one of those Broncos because it's got a stick shift," and I'm thinking, let's let them sort out their
Yeah.
problems
Let us
before we
sort
do
out the
that.
problems for. Yeah.
But
So.
like you said, that's a cool tip if it is something you need, and you're under that AGI limit. So sorry, Charlie, for
Yeah,
almost everything we talked
if it
about.
works, yeah, if it works for you, great. But again, I would rather you not pay the interest.
Okay.
That's a better financial move, in my opinion.
Well, Jed, thank you for coming on and straightening us out when it comes to the Obaba
Obaba?
one big beautiful bill act. Um, if you are listening to this and you're thinking, that guy was smart, I would like to ask him more questions. The reason we did this podcast is because somebody that was kind enough to kick us the cost of a coffee once a month to support this podcast happening. Um, Somebody jumped into our little community and asked some questions, and here we are answering them. So you could do that. You could make yourself a little volley video and ask Jed a question. He's not guaranteeing that he's going to answer it, but a lot of times he jumps in there and answers some questions, just like a whole bunch of other awesome people do. So if that's something you're interested in doing, you don't have to wait until 2026 when suddenly you get a tax break for that small charitable contribution. You could just start doing it now, and we would welcome you into the community of Abraham's Wallet podcast supporters. So think about that if you're interested. abrahamswallet.com/support. Jed, thank you for being here. It's always awesome to talk to you. I'm impressed with your ability to digest a 785-page bill in time to run us through it here on the podcast. And yeah, it's really helpful to just have a summary of what's changing. And I know the only thing we're sure of is more things will change pretty much constantly going forward when it comes to taxes.
Yeah, absolutely. Well, I appreciate you having me on.
All right. In the meantime, guys, we'll be back here next week. I just encourage you to be thoughtful about your money. Don't leave money on the table when you're doing things like making tax decisions or figuring out what you might do with your family's money. All of us have been entrusted with different amounts, and part of the reason that we exist here at Abraham's Wallet is so that you can run your home like a biblical boss. But the other part is because we want you to run your dough like a biblical boss. So until next week, keep doing it. Keep running your home and your dough like a biblical boss.